Hello, Bearable traders and Trading Terminal subscribers. Welcome to another weekly market recap where we're discussing and dissecting all the important events that happen in the week in the market. Hopefully, I can provide some insight and give you some trade ideas. And market is rallying. This week was a really strong week, and I'm sure you're confused because you open your news and you see banks are failing. You open Twitter and some people are calling for a crash. Some people are calling back to all-time high again because QE has started again. And there's a lot of new noise and there's a lot of signals. But how can you separate the two? So today, in today's video, I'm going to give you a framework of understanding what is really leading and what is really lagging. And what's really noise and what's actually signal and what's priced in and what's not. So make sure to watch until the end of this video where I reveal my framework and I reveal my my playbook for playing these. Today's Friday. We're recording this at noon Eastern time. Market is rallying very strong. SPY is coming back a little bit, but overall a very strong day off of the cooler than expected PCE or personal consumption expenditure numbers. So PCE really usually is one of those metrics that Fed really likes to look at, and similar to CPI, PCE is really involving households and very important metrics when it comes to inflation. On a weekly basis, we see IWM is up about 5%, SPY is up about 4%. So all the indices are very strong on a 1 week basis. And overall, March, despite being a lot of fear, it was a very volatile month, but overall a positive month for most of the indices. On a sector performance, as you can see, energy, consumer discretionary materials all did very well. So very strong, especially energy had a really amazing week. And if you are part of our community in Bearable Traders, one of the trades that we did with our community was shorting some puts on Oxy. So when you sell some puts, you're synthetically long this stock. So we sold some puts on Oxy, and they're expiring worthless this week, so we get to keep all the premium. So we're definitely happy about that play and that trade. Let's go to the calendar because we're going into the earnings Q1 earning releases, and they're gonna get really interesting. So next week, quite a not really a busy week. It's a shorter week as well, but the week after, that's when the banks actually start their earnings. So you got semiconductors, and then I think on the third week of April is when you see the Bank of America, Charles Schwab, Netflix, all the important companies will start their Q1 and their guidance. So a lot of stuff is happening on that front. On the economic calendar side, again, we had core PCE today, and as you can see, the estimate was 4.7% year over year, but we came in at 4.6, which is actually cooler than expected, so good sign for equities. Personal spending also lower month over month, so people are spending less money. That's another thing that Fed really likes to see. And and then Chicago PMI, which is Purchasing Manager Index, came better than expected as well. So again, showing the economy is really healthy. Next week on the economic calendar side, we have manufacturing PMI. You wanna pay attention to these on Monday. Probably, my guess is the numbers are going to be better than expected. You got the JOLTS job opening. This is another thing that Fed really pays attention to. It's kind of important. And then, of course, on Thursday, we have initial jobless claims. So I have some information in today's video about initial jobless claim and some of the stuff that I'm seeing. And now that we've talked about the overall market, let's get into this question that a lot of people have. Hey, I'm very confused. I look at Twitter. People are saying the end of the world is near. Banks are failing, but market is rallying. On the other hand, market is rallying, but there's all this bad news. So what's really priced in, what's not priced in? So let's talk about it. I want to give you that framework as I promised. So when it comes to economic news or any type of news, you can put them in three buckets. And this is very important that a lot of newer traders don't really understand how to do this. You want to put this information into three buckets. Lagging indicators. So these are indicators that are showing what happened in the past. They don't have any predictive power. Coincide indicators. These are the stuff that are happening right now. So as they come out, market would react to them. There is no preposition to that. And then there is leading indicators. So I put it as LE. And these will basically tell you what will happen in the future if everything goes well, right? So these are the buckets. So a good example of a lagging indicator would be GDP. By the time the GDP numbers comes out and it tells you, hey, the market, the economy is contracting, that's for 3 months ago. That's for 4 months ago, right? 2 quarters of negative GDP. If you think about it that way, that's like 6-7 months ago. So that's past. These have no predictive power. By the time we're already in a recession, market is usually rallying and has bottom. So you want to pay attention to that. Another one is the coincide. So this one is really employment. When you see job numbers, they're starting to tick up. That's usually as it is happening. It's a little bit of a lagging as well. But again, not a lot of predictive power. What you really want to pay attention to is leading indicators. And I'll tell you about leading indicators. These are your housing index. One of them, you can find them called HMI. Your purchasing manager index, we call them PMI. So these are the stuff that usually tells you what's going to happen in the future, because they're in the first line of the supply chain. So for example, housing, if housing slows down, there's less construction, there's less orders means less profit means higher unemployment, laying off people means higher unemployment. So you can kind of see the relationship between these. So when it comes to people talking and people being very bearish, when the sentiment is maximum bearish, that's actually a really good time to start buying the stocks, because as I said, the sentiment is really following the price, not the other way around. And I have some charts and cool graphics to show you. So speaking of that, sentiment and being coincide, so you can kind of see on the bright blue line is consumer confidence. So this is a survey that people do to say how confident are you about the economy, about your job, about the stock market. And then the lighter blue line is Fed's fund rate. And as you can see here, the consumer confidence was the most bearish at March of 2009. Can you guess what happened at the March of 2009? That's exactly when the stock market actually bottomed and it started rallying. So, by the time people are very, very bearish, and this is why a lot of the stuff that you hear on Twitter are really a coincide indicator. By the time people are really bearish, the economy has already collapsed. As you can see, the Fed's fund rate is already at 0. So that's usually the time. It's not really a leading. That's not the time to sell. That's the time to buy. That's when you actually want to buy, and then you'll see the market rallying. Another example that I have, and this is part of the analysis that I did, is looking at employment. By the time unemployment is really ticking up, it's really that coincide. By the time you see unemployment at 4%, 5%, that's not the time to panic and sell. That's actually a time to buy. Because as you can see, again, my analysis from 2008 shows, when the layoffs were happening and people were starting to get layoff, the Fed was already cutting. So again, by January of 2009, the rate was at 0. And there were still layoffs happening, and the market was actually rallying and going up. So if you were listening to everyone on Twitter or everyone on news talking about layoff and you were getting scared and you were selling your stocks, you would have missed the whole rally. So you want to really understand, okay, what is the coincide indicator? What is a leading indicator? You want to pay no attention to lagging and coincide indicators. I hope this actually helps you with your time frame, with your decision making, and with your stock trading. On the job number side, by the way, we're already seeing on a state level unemployment ticking up. So the blue line is really the state level percentage of U.S. to state unemployment claims, and this is already ticking up. So I'm assuming in the next few months you will see the actual initial jobless claim and unemployment will start ticking up significantly. But by the time that happens and panic is in the market, remember, that's usually the time to buy, not to sell. Why? Because employment and unemployment is a coincide indicator. With that being said, I want to go back to Trading Terminal and share with you a couple of new releases that we're doing, a couple of new features. So we've done some massive improvements to our calendar page. So hopefully you should see better performance, better logos, more accurate timing. That's on the back end. Again, our real-time simulator, more improvements are on the way. And our scanner is now a full package scanner. So now you have the capability to go ahead, change the parameters of the scanners, design them, configure them to exactly your liking. So let me go ahead here, accept all cookies. So as you can see, you can press on edit configuration and actually play around with all the parameters and design your own scanners, which is very, very big. Of course, be patient with us as it is in beta mode right now. And if you want to go back to Trading Terminal, you can simply go ahead and do that. And then the last thing I wanted to do about some of the updates that we're doing is on the Academy side. We just introduced a new course by Mike Bear. Mike has been in the Marine for over 20 years. He developed a lot of curriculums, and now he's Chief Education Officer at Peak Capital Trading, really involved with the learnings of our traders. And he's released a course called How to Pick the Right Strategy for You. I don't want to butcher the name, so let me make sure that's the name of the course. Yeah, How to Find a Trading Strategy. And right now, for a limited time, is actually at a discounted price. And in this course, Mike is talking about, there's so many strategies: opening range breakouts, selling premium, swing trading, using fundamentals and macro framework like myself. But how do you define what strategy is right for you? Reading the tape, right? It has something to do with your personality, how you think. Are you a slow thinker, fast thinker? It matters on, really knowing yourself and picking the right trade book for you. And this course is about that. It's over 5 hours. There is one-on-one mentorship session included in the price with Mike. It's via Zoom or Google Hangouts. And there's also a do-it-yourself workbook, which is over 40 pages, where you ask these questionnaires and answer a bunch of questions, and you really realize, okay, maybe you're not a scalper, you're more of a slow thinker, and you like to be in a trade for 2 hours, 3 hours. Definitely a tremendous value, so feel free to check it out as part of our ongoing education for traders on Trading Terminal Academy. With that, trade safe, and we'll see you next week for another weekly market update. Thank you.